Okay, imagine you're standing at a roulette table. You're in a casino, you're watching the wheel, and it's landed on red 5 times a row. Red, 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 red.
Oh, boy.
And you feel this pull, this gut feeling that says, okay, black is due. It has to be black next. So you take your entire paycheck and you just slam it down on black.
The classic gambler's fallacy. The wheel has no memory. The odds are exactly the same on the 6th spin as they were on the 1st.
Right. And most of us know that's a bad idea in a casino. We get it. The house always wins.
Sure.
But here's the really provocative question we're tackling today. Why do millions of smart, rational people engineers, doctors, people managing their retirement do the exact same thing every single day in the stock market?
It's a huge disconnect.
Why do we trust our entire financial future to a statistical model that assumes the market is safe when all of history tells us it is absolutely wild?
We're using tools designed for a calm, orderly, theoretical world to navigate a chaotic, violent, emotional one, and then we're surprised when we get hurt.
Today, we're doing a deep dive into a document that, frankly, made me want to delete my trading app and apologize to my bank account.
I know the one.
It's an 8-page slide deck titled The Gaussian Lie. And I want to be clear from the get-go, this is not a how-to-trade tutorial. This is not 3 secret tips to beat the market.
No, it reads much more like a whistleblower complaint. It feels like it was written by a data scientist who just got tired of watching retail traders lose money and decided to, burn the whole house down.
It's exposing a statistical scandal. We're talking about the tools that come preloaded on every single chart in the world. Bollinger Bands, moving averages, RSI, the default settings.
Exactly. The mission of this deep dive is to deconstruct why those default settings aren't just kind of inaccurate. They are statistically impossible. We are not going to talk about candlestick shapes or gut feelings today.
No.
We're going to talk about hard data science and why the math you're using is basically lying to you.
And look, I'll be honest up front. I'm the guy who wants to believe. I see those lines on the chart and they feel like a safety net. They give me structure. So my role today is to defend the retail trader. I'm going to try to find a way to make these tools work.
And your role? Well, you're the data realist.
I am the buzzkill.
You are the buzzkill who is probably going to break my heart with math.
I prefer to think of it as saving your wallet with math. But sure, let's go with buzzkill for now. All right, let's get into the first bombshell. This is slide 1 and 2 of the deck. The source just attacks the number 20.
Just right out of the gate.
You open up any charting platform, TradingView, MetaTrader, whatever, and the default setting for almost everything is 20 periods. 20 days, 20 hours, 20 candles. Why is the number 20 public enemy number 1?
This is what the source calls the N20 flaw. In statistics, N is your sample size. And in the world of legitimate data science, a sample size of 20 it's effectively 0. It is noise. It is statistically irrelevant.
But wait, 20 days is a trading month? That feels like a decent chunk of time to a human being.
To a human, yes. To a statistical model trying to predict the future, it is nothing. The source uses this brilliant analogy here, the coffee shop poll.
I loved this because it makes the absurdity so obvious. Walk us through it.
Okay, so imagine you're trying to predict the outcome of a massive U.S. presidential election. You've got 150 million voters, complex economic issues, geopolitical stuff. But instead of a proper poll, you walk into one coffee shop in Seattle, and you ask 20 people who they're voting for.
And let's say 18 of them say candidate A.
Right. So you run out of the shop and you bet your life savings that candidate A is going to win the national election in a landslide. You would be considered insane.
Because those 20 people might all be friends. They might work at the same tech company. It's a tiny, biased little bubble.
Exactly. It represents nothing but that specific coffee shop at that specific moment. Yet, traders look at the last 20 candles on a chart, which is a tiny, biased slice of time, and they think they can predict the global flow of capital.
Based on just that.
They think they can predict what Goldman Sachs, the Federal Reserve, and the Bank of Japan are going to do next based on 20 data points. It's statistically void.
Okay, I hear you. 20 is too small. But I'm going to push back here. I'm the trader trying to fix this. This seems like an easy fix, right?
Go on.
If 20 is too small, I'll just crank it up. I'll go into the settings and change it to a 200-period moving average. Now I have 10 times the data. Sample size of 200. Problem solved.
Yeah. You would think so. And that is the parameter trap. I see this constantly. You think you're fixing the data problem, but you're actually introducing a new, deadlier problem called smooth lag.
Smooth lag. That sounds technical. Break that down for us.
Think about turning a speedboat versus turning a supertanker. The 20-period average is a speedboat. It's fast, but it gets tossed around by every little wave. That's the noise.
Right.
So you switch to the 200-period average. That's the supertanker. It's stable. It ignores the little waves.
That sounds good. I want stability. I don't want to get faked out.
But what happens when the market direction actually changes? The speedboat turns instantly. The supertanker takes 5 miles to turn. By the time your 200-period average actually curls up to signal a buy, the rally is already over.
I missed the move.
You missed the entire move.
So it's a lose-lose. If the number is small, the data is just garbage noise.
Yeah.
But if the number is big, the data is too old to be useful.
Precisely. You cannot fix a flawed model by feeding it more old data. That is the key takeaway of the parameter trap. Changing the parameters is a futile exercise. You're just smoothing out history. You aren't predicting the future. You're just drawing a prettier, smoother line through the past.
That is incredibly frustrating. Feels like there's no winning move there. But let's move to slide 3 because it gets even deeper. This isn't just about the amount of data. It's about the shape of the data. The document calls this the Gaussian lie.
This is the core of the whole argument, and this is where we have to talk about the bell curve.
Now, for those of us who haven't taken a stats class in a decade, refresh our memory. What is a Gaussian distribution?
It's just the standard bell curve, shape high in the middle, and it tapers off on both sides. It assumes that most things happen in the average range, and extreme events are super, super rare.
Like human height. That's the classic example, right?
Exactly. Most men are around 5'9", 5'10". You might see someone who's 6'5". You rarely see someone who is 7 feet. You will never see a human who is 100 feet tall. The math forbids it.
Right. So Bollinger Bands, one of the most popular indicators in history, are built entirely on this math. They use standard deviation to draw bands around the price. And the theory is that 95% of all price action will stay inside those bands.
Which implies that the market behaves like human height. It implies that extreme events, crashes, explosions are statistically impossible outliers.
But the source argues that financial markets are not human heights.
No. Markets do not follow a bell curve. The source, and frankly any serious quantitative analyst, will tell you that markets follow a power law. They have what we call fat tails.
Fat tails. It sounds like an insult, but it's a statistical term.
It is. If human heights followed market mechanics, you'd have mostly average people, but like once or twice a year, you'd walk past a giant who is 3 miles tall.
Whoa. Okay, that puts it in perspective.
In a bell curve world, Bollinger Bands are built for a market crash like 2008, or the COVID drop in 2020 should happen maybe once every billion years.
Yeah.
It's statistically impossible.
But in reality,
in the power law world we actually live in, these crashes happen every decade, sometimes every few years.
So the model is telling you this is impossible, right as the market is crashing 10% in a single day.
And that is the danger. The slide makes this chilling point. Bollinger Bands do not contain risk, they hide it. When a black swan event hits a massive crash or a sudden parabolic rally, that is exactly when you need protection the most. But that is exactly when the Gaussian model breaks.
It fails when you need it.
It gives you a false sense of security right before you drive off a cliff.
It's like wearing a bulletproof vest that's guaranteed to stop everything except bullets.
That is painfully accurate. It works perfectly when nothing is happening. But when the shooting starts, the math just dissolves.
Okay, so the bands alone are flawed. I get it.
Yeah.
But let's play the advocate for the retail trader again.
I'm stubborn. I know one indicator isn't perfect. So I'm going to go to slide 4. The source calls it the myth of confirmation. I call it the safety in numbers strategy.
Or as I like to call it, doubling the delusion.
Ouch. Here's my logic. Tell me where I'm wrong. I'll use Bollinger Bands and the RSI and the max DD. If the bands say buy and the RSI says buy and the max ED says buy, that has to be statistically safer, right? 3 witnesses are better than 1.
This is probably the single most common trap in all of trading. And let's look at the probability fallacy the source lays out. You have probably done this napkin math yourself.
I definitely have. I say, okay, indicator A has, say, a 60% win rate. That means a 0.4 chance of failure. Indicator B is the same. So the chance of both of them failing at the same time is 0.4 times 0.4, which is B-beta-1,6.
Meaning you think you now have an 84% win rate. Exactly. The math checks out. 1 minus 0.16 is 0.84. I've hacked the system. I have an 84% win rate.
But that never happens in real life.
It doesn't.
If that math were true, I wouldn't be sitting here talking to you. I'd be on my yacht buying small country.
Fair point. So why is the math wrong? 0.4 times 0.4 is 0.16. That's just multiplication.
Because that formula multiplying probabilities, it only works for independent variables.
Okay.
Like rolling two separate dice. If I roll a 6 on one die, it has zero effect on what the other die does. They don't talk to each other. The outcome of die A has zero influence on die B.
But indicators aren't dice.
No, they are what we call dependent variables. This is the whole concept of multicollinearity. Think about it. Bollinger Bands, RSI, MCD, where do they get their data from?
They all look at the price candles.
They are all looking at the exact same list of numbers. They are siblings, not strangers. They're effectively inbred. If price drops, the bands drop, the RSI drops, and the MACD drops, they aren't giving you three separate opinions.
They're giving me the same opinion in 3 different languages.
It's like asking your mom if you're handsome, and then asking your dad, and then asking your grandma.
They're all going to say yes.
Exactly. They all love you. They're all biased by the same source connection. You haven't confirmed the truth. You've just confirmed the bias.
So when I see 3 indicators lining up, I'm not seeing increased probability. I'm just seeing an echo.
You are increasing your confidence, but you are not increasing your accuracy. And in trading, confidence without accuracy is how you lose everything. You bet big because you see 3 green lights, but they are all connected to the same broken switch.
That really stings. It explains why you can have 5 indicators screaming buy and the price still tanks.
Because they were all analyzing the past price, and guess what? The past price just changed direction.
Which leads us perfectly into the next section, slide 5 and 6, visualizing the past. The source uses an analogy of driving a car.
Yes, driving while looking exclusively in the rearview mirror. Indicators are drawn after the price moves. They are a historical record of volatility, not a predictive map of the future.
There is a term the source mentions that I think every trader has experience with, just absolute horror. It's called walking the band.
Yes, the classic retail trap.
Picture this. The price hits the upper Bollinger Band. The trader thinks, aha, it hit the limit. Standard deviation says it's a statistical anomaly. It must come back down. So they sell. They short the market.
And instead of dropping, the price just keeps going up.
And the band it bends.
The band pushes outward. It expands to accommodate the volatility. It doesn't stop the price. It just makes the room bigger. And the trader keeps selling, thinking it has to turn. The math says so. And the band keeps expanding. And their account goes to zero.
It is a harsh reality check.
Wow.
Speaking of which, slide 6 pivots to the competition. We aren't trading in a vacuum. We are trading against other people.
This is the David versus Goliath slide. And honestly, it is probably the most sobering part of the entire deck. The source brings up the hedge fund survival rate.
This stat blew my mind. We tend to think of hedge funds as these invincible money machines.
And they have a license to print cash.
Yeah, but the data says otherwise.
The source notes that even with physics PhDs, supercomputers executing trades in nanoseconds, satellite data, and virtually unlimited capital, about 60% of hedge funds close down within 5 years.
60% fail. These are the pros. These are the guys we are trying to beat.
These are the apex predators. And more than half of them can't survive the market for 5 years.
So the devastating question the source poses is, if the guys with the supercomputers and the insider info are failing, how on earth can a retail trader expect to beat them using a generic formula from the 1980s that comes free on a charting app?
It frames the situation perfectly. It is not just unlikely, it's structurally arrogant. To think that a 20-period moving average gives you an edge over a Goldman Sachs algorithm is delusional. Goliath has a laser, and David has a slingshot with a broken rubber band.
That really puts the I found a secret pattern idea to bed, doesn't it? If it were that easy, the survival rate for funds would be 100%.
Exactly. If default settings were profitable, no hedge fund would ever close. They just turn on the bot and go play golf.
So if the math is a lie, and the tools are flawed, and the competition is just killing us, why do we keep doing it? Slide 7 introduces a concept called the swamp.
The swamp is the psychological trap. It's the cycle of endless optimization. You know this feeling.
Oh, I live in the swamp.
Yeah.
Walk us through the cycle.
It's Sunday night. You backtest a strategy. It fails. So you change the settings. Maybe you change the 20 to a 50. It fails again. So you add another indicator. Backtest again. It fails. You change the time frame from 1 hour to 4 hours. You download a new custom indicator.
I have definitely spent entire weekends doing exactly this. Just tweaking numbers, hoping the backtest line goes green.
We all have. But the flaw is philosophical. You are searching for a deterministic answer in a probabilistic environment.
Explain the difference for us.
A deterministic system is a machine. If I press the A button on a vending machine, a Snickers bar falls out. Every time. A causes B. Traders want the market to be a vending machine. If RSI crosses 30, then price goes up. They want a rule.
But the market isn't a machine.
No, it is a chaotic system of human emotion and liquidity. It's probabilistic, anything can happen, but you're sitting there tweaking settings, trying to find the magic button combination that turns the market into a vending machine. It doesn't exist.
The source mentions something interesting here about self-fulfilling prophecy, that sometimes these lines do work.
And that is what keeps you in the swamp. That's the addiction. Sometimes the price bounces off the 200-day moving average perfectly.
Yeah.
Not because the line has magical powers.
But because millions of other people are staring at that same line and buying at the same time.
Correct. It is crowd psychology, not math. But because it works sometimes, you convince yourself that if you just tweak the settings a little more, it will work always. And that is the trap. There's no answer key hidden in the chart history.
Okay, we have dismantled the default settings. We have exposed the Gaussian lie. We have realized we're fighting supercomputers with broken tools. If we stop here, this is the most depressing deep dive we have ever done.
It's pretty bleak. Yeah.
But slide 8, the last slide, it offers a solution, a pivot. Price, math.
Price over math. Stop trading lines, start trading structure.
What does this source mean by that? How do I trade if I can't look at my lines?
It breaks it down into 3 pillars. If you want to understand where price is going, you have to ignore the decorative lines and look at the engine. The first pillar is liquidity.
Liquidity. That's a buzzword in finance. What does it actually mean for a trader staring at a screen?
It means, where is the money? Where are the stop losses sitting? Where are the big pending orders? The market moves toward liquidity like a magnet. It doesn't move toward a moving average. It moves toward the pile of cash.
So not where is the line, but where is the pain point for other traders?
Exactly. The second pillar is psychology. The fear and greed of the masses. Is the market panic selling? Is it euphoric? Indicators lag, but fear is instant. You can see it in the speed of the candles, the volume spikes.
And the third?
News, real-world valuation shifts. Interest rates, wars, earnings reports. These are the things that actually change the fundamental value of an asset.
It seems so obvious when you say it, but as traders, we get so obsessed with the chart that we forget the real world even exists.
The source makes a great final analogy here. The chart lines, the indicators, are just the exhaust fume coming out of the car.
The exhaust fume.
Think about it. The news causes the psychology. The psychology drives the liquidity. The liquidity moves the price. And the price creates the indicator. The indicator is the absolute last thing to happen. It's the smoke coming out the tailpipe.
And you can't drive the car by looking at the smoke.
You really can't. You have to look at the road.
So what does this all mean for the listener? We've covered a lot of ground, from the N20 flaw to the lie of the bell curve to the exhaust fumes.
I think the big takeaway is to move from being a believer to being a skeptic. When you open your charting software, look at those default lines. Don't see them as magic barriers. Realize that they're just averages of the past. They aren't predicting the future any more than a history book predicts next week's lottery numbers.
It's about recognizing that the market is messier than a bell curve allows for. It's wilder.
And realizing that you can't math your way out of uncertainty. The institutions know this. That's why they focus on risk management, not prediction. They manage the downside. They don't try to predict the future with a single line.
I want to leave the listener with the final provocative thought from this source material. It really stuck with me. The author asks, is your chart a map of the market, or is it just a comfortable illusion that hides the risk? Are you trading the market, or are you just trading your own anxiety?
That is the question, isn't it? Are those lines there to help you make money, or are they just there to make you feel safe in a very dangerous room?
A tough question, but one we all need to ask before we place that next trade. Next time you see a perfect setup on the bands, ask yourself, am I looking at an opportunity, or am I just staring at the rearview mirror?
Keep questioning the defaults.
Thanks for diving deep with us. We'll see you next time.
See you then.